I very much appreciate participating on this panel and in this show. Sydney does a wonderful job. And what I do most commonly is I take people through the process. I have probably 8 shows a day where people call me wanting to get into the business, not knowing how. They may be a real estate company. They may be, quite frankly, just an entrepreneur with a dream. And we typically talk about every one of the subjects we've talked about today. And so this show is a great opportunity for me to sharpen my sword so we could bring the people to market and provide the technology they need to be successful.
Hi, I'm Nigel Hobson from a company called Afex. I think I'm the odd one out here because I knew very little about crowdfunding before today, and my knowledge has gone up 100-fold. What we do is we provide international payments and foreign exchange risk solutions to corporates traditionally. About 18 months ago, we developed an API that hooks into our payment engine that allows us to partner with companies to pay out to over 200 countries globally and receive funds in, hold balances in up to 16 currencies in like a treasury type function in the background. So I don't know how relevant it is to everybody, but I know it's relevant to this guy. So it was worth me turning up, and I'm just here to see, where we can possibly help you guys who are moving money, because that's what we do, move money.
I'm Craig Denlinger, founder of Artesian CPA, and started a website, CrowdFund CPA, about 4 years ago. Been involved with this for quite a while, and started my firm to focus on providing the services for audit and review under the requirements of the Jobs Act for both Title IV raises currently and in the future Title III raises. Right now we're working with about 20 companies going through a lot of the major platforms and attorneys around the room here today.
I'm Mark Lancaster, president of Great Lakes Fund Solutions. We are an outsourced investor services back office for investment funds, typically ones that are organized as limited partnerships or have pass-through tax features. So we coordinate with the controller of the firm. When they're done with the period end, we are allocating the returns of capital, distributions, and other attributes to each of the investors, processing ACHs, preparing monthly statements, and then hosting a web-based portal for both the investor and the advisor, who may have been involved with bringing the investor into the fund, host that web-based portal so that they can see documents and data relating to their investments. On top of that, I have a product line called CrowdKey, which is a white-labeled crowdfunding site.
Hello, I'm David Dobkin with the ASMX. I spoke before. Just in quick summary, we are a turnkey investment bank for Regulation A+ securities.
Hello, I'm David Gosselin. I'm a CPA, and I'm an audit partner at DBB McKinnon. We're a full-service PCAOB registered public accounting firm. For the last 12 years, I've primarily focused on small-cap public companies that trade on the OTC markets. And we've gotten involved in Reg A+, and we'll be involved in Title III, and we got a handful of companies currently going through the process. And I think, like everyone here, the best thing about working with these companies is we get to work up with startup companies that have a dream, an idea, a little money, hopefully, and trying to make something special happen.
So nice to make it special. All right. My name is Oscar Jofre. Just curious, with the crowd here, it's probably getting a little confusing about what we all do in technology. How many here are actual companies? Great. I'm here for you. Okay. So what we do, we provide a technology for companies to get you well organized to go to crowdfunding, to platforms like ASMX and others, to make sure you're well prepared. And then on top of that, you get an actual platform to manage all your shareholders, to be able to communicate with them, and to make sure you meet your compliance requirements. So we're not a portal. We're all about you, the company, to make sure that you've met all your requirements throughout this process.
My first question would be for David Gosselin. David, your firm is a PCAOB auditor, which is required in certain instances. Is it required at some stage of Title III, or is that just a regular accounting?
No, it's not required
Okay,
for
the
Title
Title
III.
IV, you're required if you want to list.
So in Title IV, you're not required to use a PCAOB firm. And I think if you're using any firm besides myself or Craig's, you're going in the wrong direction. But I'm in the mindset that even you're not required to use a PCAOB firm, you should. And the reasoning I always tell issuers is because if you do intend to go public, if you are using this as an on-ramp, you need a PCAOB registered firm to be a part of the Exchange Act. And if you don't have that in place, then whoever does become your PCAOB firm will have to go back and re-audit at your cost. So it's better just to use a PCAOB firm in the first place. It doesn't cost you anymore. It's the exact same price, all things being equal. And I don't know why you wouldn't.
Okay. If I need an audit, what's the absolute minimum that I could have an audit done for? Let's say my daddy gave me some money and I started the company and I needed an audit. What's the cheapest I could get it? Let's say my daddy put some money in the bank for me and it's all zeros, but I have to be compliant and I have to have an audit. What's the cheapest I could ever do that for?
That's a loaded question. I think from what I've seen,
it depends, right?
You're really just required to get a beginning balance sheet audit at that point. But most of the work is actually in the financial statements, reading them, making sure all the disclosures are there. We have compliance on our end that nobody else sees. So my guess is that's going to be right around $2,500, $3,000 for the most basic thing that's absolutely possible. Craig, you got any?
I'm gonna get Craig in a second.
Yeah, that's
Craig. You're next.
2,500 is
And that's
what I'm charging for the
that's
basic
about
details.
That's bare bones. Absolute
That's
minimum.
about the bottom if it's all zeros, right?
Part
Now-
of our
now-
requirement is we have to issue a consent letter, which means I have to read that whole offering circular, cover,
right.
recover,
I
and tile
see.
every number in there and stuff like that. So most of my time is actually on the back
Okay,
end
now
rather
tell
than the
me,
audit.
obviously I can't just show up with a checkbook, right, and hope for an audit. What, Craig, you want to tell us what would be required? You know, one of the things we wanted to talk about is a startup accounting costs. And there are people that are startups. They're real startups, and a lot of these startups are very green and novice, and they don't know, a set of books, as far as they're concerned, is like encyclopedias. So what would be the startup costs and issues that a new young company would really want to be concerned about?
Yeah, the big thing is before the audit, you need to have someone in there that knows what they're doing from the accounting standpoint on independent standards, limit what the auditor can actually do. So there's a lot of different things a startup can do at an early stage that make things very complicated and hence expensive. You have to put together full GAAP financial statements, which isn't just your tax numbers. You have to value everything. So if you paid for something with warrants, you got to determine what those were worth when you issue them and recognize that as an expense. And why that's important is the rules for accounting for this stuff is to make everything consistent. So I'm looking at company A versus company B. If one was paying for everything in options and warrants and the other one was paying cash, the one paying cash is going to look a lot worse if you were looking on a cash versus cash basis, but the true economic substance is what matters, and hence why there's a lot of work that goes in when you get into complex things like derivatives and convertible notes and stuff like that. So I guess the big point is to make sure that your accountant understands what you're doing and is able to handle it internally before you go looking at getting an audit done.
I mean, can a regular bookkeeper submit things to you? Is that how it would work? I mean, if I'm a startup and I don't know anything yet about, I've got this marvelous new watch or whatever, and I want to, and my daddy gave me some money, and I want to get started. What would I do? Would I hire a bookkeeper to get us? What do I need to submit to you to do the audit exactly?
If you don't have the internal capability, you need to get someone hired in before you go about the audit.
You have to do audit prep, right?
Exactly.
And so in the audit prep, can you go through some of the things that might be you'd be concerned about?
Yes, from the bookkeeper's perspective?
Yeah, I mean, just from your perspective, what do I need to give you as an issuer?
Just keeping good records as you go. First of all, make sure you have everything readily available. And then, like I was saying, the derivatives, the complex type of transactions you're involved in, your revenue recognition policy, you need to have someone competent on your end to get all that put together.
Okay, now, would you guys mind if we take questions as we go along? Is that okay? Because, you have to wait a long time. You had a question out there, sir?
Yeah, I'm wondering, I can just speak loud. I wonder how your answers would change if this is a fresh out of the gate startup that just has a business plan and just started their legal structure.
That's one of the things we really want to address, because with this new system, Media Shares is, by the way, I forgot to tell you what Media Shares is consulting with companies in exactly that stage right now, and they think dilution is when you add a lot of water to so you're absolutely correct. Can we get into his question?
Yeah, you were asking about the cost or the preparation, or?
Not so much the cost, but let's say I've got a new company with some good resources, but they don't have a track record. They just have a business plan, and they just formed a, LLC or S corp or something. How does that work?
And their daddy gave them some money,
So you're looking at Title III and doing the crowdfunding traditional, what's coming up in 3 months' time.
That's right.
So the portals that are coming up, there's a lot of people in the different service providers here, and we all have the capability of supporting you as a company. What you would really want to know is how much money you're trying to raise first, and if it's under that $1 million threshold, then it's really about being compliant for that. So you need to do not an audit, but you need to do a review. And then there's a couple other requirements.
Yeah, what is that? Are you talking about Title III?
Yeah, Title III.
So you gotta have a CPA do that?
Yes.
You gotta have a CPA, and they prepare a financial statement, right, of some sort of record of what the financials are?
I think we, as a CPA, we always need to make clear that the financial statements are not ours, they're of the companies, and they're your financial statement, not ours. And the problem that we run into is that most most people cannot write financial statements. They don't even know where to start. And I always tell people, at least give it the old college try. There's enough out there. You can search the Edgar system for common standard disclosures. If you give it the college try, that's all we need to maintain our independence.
And the portals themselves will actually help you through this process. If you're a brand new company that hasn't done anything yet, the first thing is you have to incorporate, and go through those processes, and then you put the application in. So the Title III portals are going to be, they're going to lay it out for you in terms of an application and say you have to do all of these steps. And once you go through those steps and apply, if they like the concept, because we're talking about seed funding at this point, it's just the seed funders are now coming through the crowd as opposed to the angel network, and it's the same type of environment, and you're going to have to say, okay, just to do that, there's going to be some costs involved. Hopefully it's not burdensome to do the different steps that you're going to need to get there, but
now, Oscar.
Yeah, Oscar's going to be.
Oscar, you would come in a place like that, and I know you handle the documents and help them get set up. Could you want to tell a little bit what I would do if my daddy gave me some money?
Well, the good thing is I don't charge you anything. I'm free. But that being said, the time and effort you have to do to get ready is imperative. It's for Title III in particular, issuers are going to be required to be fully prepared, as David outlined. It's not going to be something you just go there with an idea. You're just going to be incorporated. There's going to be certain other requirements that you're going to need to meet. And what we've offered you is the ability to come into a platform that's costing you nothing to prepare all your documentations so that way you can submit it securely to one of these platforms, right? We're not guaranteeing that they're going to accept you. We're not guaranteeing you there may be any that may accept you, but at least you're getting yourself prepared for that process. That's only one stage. And some would say that that stage is probably the biggest burden. It is. You can pay a lawyer to do it for you, $10,000, $15,000, $20,000, or you can do it yourself and save a lot of money. The one area you can't save is the accountants. They have to prepare the books. And obviously there'll be additional things such as background checks you're going to have to do in yourselves. Again, these are online systems that you can perform for yourself. But make no mistake, being prepared is going to be the key going into Title III. These platforms are not going to be ready for you otherwise.
Craig, what would you be doing at this stage for an early company?
From the accounting standpoint, being on the audit side of things, I'm giving them the advice I was just saying, and making sure that they have the right pieces in place, especially if it's a brand new company, that they're set to move forward once their financial statements aren't a 6-page piece of cake. And the other big thing with an early stage company is really comes down to deal structure, in particular with the Reg A, the dilution section of the circular. Is hugely important, especially for an early company that, when I'm investing in, say, a real estate deal, if I'm going to get diluted 50% on the book value, the founder's keeping 50%, I'm essentially buying, 50 cents for every dollar I put in of the actual underlying asset. And the same applies to tech. It's just a lot more severe usually because of the, growth projections and stuff that they have. So that's something to think about early stage on a company as far as how you want to structure it to make it enticing to an investor. At the end of the day, you're not going to raise money if you don't structure something right.
David?
Can I add something to that?
Yeah.
One of the most important things, I think, is that you keep your debt and your equity very organized. Because most startup companies I talk with, they say, the books are clean. And unfortunately, I think the QuickBooks and Xeros of the world have basically told people you can be an accountant. You can be perfect. And unfortunately, that doesn't exactly work in our world. And when I speak with startups, they tend to say, everything's there. Cash, bank, easy, easy, easy. Well, did you issue stock options? Yeah, I did. Did you account for them? No. Am I supposed to? It's not cash. What does it matter, right? Did you issue warrants with your debt? Yeah, I did. Did you account for them? What does that matter? No. Is there a discount on your convertible debt? Yes, there is. Did you account for it? No. Well, all these things matter to people like Craig and myself because they drastically, that's exactly right. 80% of our risk in an audit is usually in the debt and equity sections. It's not the cash that we can track. It's the stuff we can't track. It's a little minutia in the debt agreement that says you can convert into an infinite number of shares and dilute the company out, and it creates a derivative. It happens all the time, and that's where all the risk is.
Rod, at what stage would your company come in? Yeah.
So when you're talking about portals, we come in with the people who want to have a portal, who don't want to build it themselves. We give them the technology to brand their own brand and launch a portal that could do basically in any offering type in any jurisdiction, including multiple jurisdictions and multi-offering types. So instead of having a technology that was built specifically for Reg D, and then kind of morphed into Reg A Plus, and hopefully works with Title III, and hopefully works with interstate, and oh, by the way, could it work with Canada or Mexico or UK or any other jurisdiction? Our technology allows people to augment and facilitate and streamline their core business and not dictate to their core business what they're doing. So you now see with all these different offering types, if you have restrictions through your technology, it's going to directly impact your ability to market your product, to reach your target audience as the legislation moves, as the regulations move. Your technology has to move with it. It's been said many times, and I very much agree, that technology will not make you successful in this space. However, it could make you fail quite quickly if you don't have the correct one. Just like not having the correct legal will make you fail, not having the correct audit will make you fail. There's many, many moving parts to the crowdfunding mousetrap. Technology is simply one of those parts that has to work, and that's what we do is we provide a basically universal technology to allow you to crowdfund in a compliant manner.
Now, Brent, you have any comments?
I am Brent.
Oh, you're Brent. I'm
Yes.
sorry. I thought is Rod's next to you, right?
Nigel.
Huh?
Nigel.
Nigel. Sorry, Nigel. Nigel, you have a comment here?
I don't think I can add to that because what we do is in the background behind it all, moving the money. So
Tell me.
I do. I have one comment on, you hear this at crowdfunding events, and this is no offense to you at the end regarding crowdfunding. I love it how, you as the audience sit here and you get all excited about, hey, I can go crowdfunding anywhere in the world. And I'm a Canadian, and I get to travel everywhere. And I can tell you, yes, the regulators are certainly making it easier for you. Yes, technologies are also there to help you facilitate. But please make no mistake about one fact. Just like the US regulators are regulating how crowdfunding is happening here, it's the same cause and effect in every other country in the world. So just because some technology makes it look and simplify it for you, it still requires the same underlying regulated people behind it. So if they don't have a broker-dealer, chances are you're breaching Securities Act in that jurisdiction as well. So now it's just got to make sure that at all times, wherever you're going to do your crowdfunding, you have your professionals, whether you're accountants, and I'm sorry we don't have any lawyers here, but this is really important. Don't do anything without your lawyer. I'm sorry, I'm a great tool. It's going to help you organize information, but I'm not a lawyer. I'm not an accountant. I'm only here to make sure things get organized according to what regulations are you there to meet. But you need somebody to interpret those things for you. So otherwise, in this world, if you get caught, it's not the same way as it was 5 years ago. Everybody gets to find out if you made a mistake very, very quickly. And we don't want that to happen to you. So.
Now we have a question.
Go ahead.
So, what can someone do to make it to make your job easier? So they're ready to make a portal, and what can they do to make that process go by as smoothly and as quickly as possible? Because that can obviously be you can get websites caught in just this hell where they just never get done. You spend endless times revising them, and what can you do to make that go faster for the people who are making the portals?
So every portal we launch, we give a questionnaire and a lot of homework. And you'd be surprised how many people want to jump into this game without having their proverbial ducks in a row. And so if we're asking for a business plan, so we can understand how we're going to best support your business, so we can configure the portal around your business, and you don't have a business plan, that's a problem. We don't do audits. We don't do the service providers, but we expect you to come to the table with the business knowledge, with the business plan, ability to execute. So while we help and hold your hand through the setup process, we don't replace any of the necessary parts that are on this panel. Right? We're not going to go ahead and do your books real quick for you. We're not going to go ahead and be a graphic design shop and create a logo for you. We're not going to do all the core business things, whether they're small or big. The successful portals are often the existing businesses that have raised capital for 5, 10, 20 years. They know who they are. They know all those things. They're not inventing themselves through a portal. They're just leveraging the technology to automate and streamline their existing business. When you have a brand new business and they don't know what they don't know, that's when it becomes challenging. Not insurmountable for some, but insurmountable for others. But that's when it's difficult for us to say, when we're just teaching the basics of crowdfunding, the basics of the concept, the basics of business. I get some people come to me and go, we're intrigued by one of your competitors because they're real estate experts. And my response is universal. If you're looking to outsource what's supposed to be your core competency, you're going to fail. If you don't come to the table with your own knowledge of your own business, you can't outsource that. And so you have to have a realistic expectation. What do you want your technology provider to provide? What do you want your other service professionals to provide? And if you have an unrealistic expectation, if someone is suddenly selling snake oil or certain pixie dust, we could do it all, there is no pixie dust in this equation, right? Anyone who's done a raise could tell you all the blood, sweat, and tears that had to go into Elio Motors for a successful raise. And so while we facilitate it, while we are, I believe, the best at it and the most successful at getting you live, it's still a lot of work. So being prepared and having your ducks in a row, it's a lot easier for a service provider, where the auditor or anyone else, to do their job to support you in yours. Did I answer your question?
Yeah, that was actually kind of selfish. I'm actually a competitor of yours, and I wanted to do that for both of us, so that these guys knew that for both of us.
You're welcome.
Are there any issuers in the audience, or are we all service providers at this point?
No, they're all accredited investors out there.
I think it's important to recognize that there is a back office associated with this process. You raise money from hundreds of investors. There is complexity associated with keeping track of the waterfall calculation, their address in the summer, their address in the winter, the tax ID number of their custodian if you're taking IRA investments. The list goes on and on. And in our business, we, as an outsourced investor services back office, we run into offline firms that have raised money from accredited investors, maybe 400 of them. And they didn't read the PPM in full detail. They started to keep track of things. They got in over their heads, and now they want to outsource it. And this is a world where you may raise money from thousands of investors. The propensity for that to go horribly wrong, if you try to do that in Excel, is very high. And that's just something that doesn't get talked about in these circles at this stage in the game, in a large part because people are mostly focused on getting the business launched, getting the money raised.
Gentlemen, let me introduce Rod Turner. Rod, we combined two panels together for time purposes, and Rod's want to introduce himself and tell a little bit about your company.
Okay, thank you. I love accountants. I don't really like accounting, but I feel like I've been dropped into a foreign alien planet or something. There's too many presenters, so none of us will have enough time. And the subject, it's accounting. I understand it and I work with it, but it's not my forte. So I will talk just for a brief moment about Manhattan Street Capital. I have the good fortune to have played a role in building 6 successful startup companies to scale, of some reasonable scale, Symantec being one of the ones that is still known. We launched the Norton antivirus under my watch. I ran the merger of the Norton business into Symantec, which we then grew that part of the business very rapidly, and it really became Symantec in its current state. I have and 5 other successful startups, Ashton Tate in the way early days, before IBM introduced the PC. I was at my first startup, Ashton Tate. So lots of fun experience, lots of VC experience and angel investing. I made money along the way and then blew a lot of it on what I thought were investments, but I was really spending the money, I guess. Anyway, so I've learned a lot, done a lot of mezzanine deals and angel deals. I even did my own venture capital firm in the late 90s in the first internet bubble, which was another very expensive learning experience, but really rich, really good experience. So I did my first fintech company was called Start.ac. We launched in 2012. Simultaneously, the Jobs Act was announced. As we announced my company, it was donation crowdfunding of startup companies, which notably fell on its face. I don't really think the Jobs Act is to blame for that, but it certainly didn't help any that we weren't selling shares when that was the talk of the day. But that prepared me, got me interested in. I was already interested in crowdfunding, but I've been paying attention since then. Reg A Plus, upon announcement, a week later, I focused on it. I heard about it and focused on it. Decided to do this company, Manhattan Street Capital. We launched last year in May as the first live Reg A Plus dedicated platform, although we had a different name then, Fund Athena. We were the first mover, May 16th. We renamed the company Manhattan Street Capital, not to confuse people, because we are based in San Diego, but because it's a cool name. And if I was going to rename the damn business, I was going to pick a real name that worked well this time. So the focus of Fund Athena was on women-led businesses. We didn't get the engagement from successful women that I was hoping for, even though we did have a great woman CEO for some time there. Anyway, Manhattan Street Capital, confusing geography. I get phone calls at the wrong time of the day on a regular basis.
Are you a FINRA broker?
We are partnered with a broker-dealer, and we will be their registered representative. I will personally be their registered representative.
Okay.
We will charge a fee on all capital raised. We have not done any companies yet. We are focusing on select, I call them mature startups, the companies that took 4 years to do that overnight success.
Do you have to be profitable, or can you?
No, they don't have to be profitable. It has to be a genuine company that has a reason to exist. Strategically, it's going to be around for the long haul because of the caliber of the team and the opportunity. And it's easy. It's more exciting to do it to raise money for companies that are established, like Allegiance we heard from earlier, companies that are growing and have scale, because they're less risky. There's less lawsuit risk. But we're doing that type of company. Those companies that we're looking at today have to have consumer engagement to them, because I don't think it's too smart to depend upon accredited investors to fill the coffers. We're going to get much more traction more quickly with consumer investors. So that's part of our current selection process. But I wanted to ask a question. I've been here all day. My plane was late, but then the conference started late too, so it was kind of cool. Although I'm paying the price now. Well, we are. You are, because I'm talking. So
they'll charge you later too.
Yes, so. I agree with that. I lost my point. With my joke, I lost my point. What the hell was I talking about?
Actually, I want Nigel.
Yeah.
Oh, my question, I've been here all day, and I wanted to know what the heck everyone's here for. I mean, how many of you guys are here to raise money for something? Okay, and how many of you are focused on a raise above, say, 4 million, being my interest level above 4 million? Okay. And how many of you are already in the process of raising money through some means of crowdfunding? Okay. And how many of you are service providers to this wonderful new area? Cool. Okay.
Yeah.
And how many of you are building competing platforms of one form or another? Whoa, about a sizable number. Okay, so I wanted to get that earlier in the day. Now I've got it that kind of too late. Helps me decide what to say. But yeah, the last panel, just before I wrap,
well,
I've got maybe
we got to give some
seconds.
other time to some of the other guys
let
too,
me
Rod.
say one thing and then I'm done, and I can leave.
No, don't leave, because we got other questions.
Okay,
coming.
so the one thing I'd like to say is those of you who... What? Yes. Is that okay with you if he answers the question? There's already too many of us, dude.
Got a microphone coming.
I'm a newbie to crowdfunding and crowdsourcing and all that. I've done it the conventional way on Wall Street for many decades and quite successfully. But now, as semi-retired, I'm investing in creating a company for visiting scholars, and right now financing it myself. At some point, when we go to the next phase development, where I hope to raise tens of millions of dollars, there is the opportunity, I believe, to, quote, crowdfund, or in particular, in this case, be faculty fund, because we're tied to campuses, universities. And one of the things that I'm trying to get from this conference, which I still have not gotten, is what is the right structure to create a deal like that? Is it Title III? Because I got in the previous talk confusing statements that Title III may not be the right one. Reg A plus could be the right one. And what is the process by which investors that would invest in something like this would get returns of their money? Because I'm a firm believer in making sure they get returns, otherwise they might come after me at some point, which I don't want. And even though I'm an LLC and various shields, I still don't want my reputation to be tarnished. So one of the things that I'm hoping to find, and maybe one of you can approach me later on or advise me in some manner, is how would we structure a means of raising money from a targeted group of a crowd, in this case faculty, and provide appropriate returns. Would it be in the form of dividends, or be a debt financing, or would it be equity? And if it's equity, what is the form of liquidity to enable them to get return on their equity? So those are very big questions.
Well,
that
first of all, you're going to
unanswered.
need to be dealing with non-accredited investors.
I'm sorry?
You're going to be, if you're dealing with the faculty, the chances of them all being accredited is remote. Most teachers and professors are not normally very wealthy. So you're going to be dealing with non-accredited investors. So you have two options, basically, Title III and Title IV. Title III is up to $1 million. So if you're planning on raising more than that, you can raise up to $50 million with Title IV. So right away, if you're raising more than $1 million from non-accredited investors, you're going to be looking at Title IV. There's really not much escaping that. And then Title IV, from everything that all the homework we've done, is a couple of $100,000 cost to do that, truthfully. And you would start with a 506C to some accredited investors. You can do that with very little regulation. You file a document, you get 506C. You come to a fellow like Rod, he'll help you, another broker. You go to several brokers and you try to get them to help you, and you can syndicate it in kind of a mini syndication. And you can take money from accredited investors with basically a napkin, practically, and they write you a check. But realistically, you either have to have a subscription agreement or a PPM, and you take money from them. You want to do Title IV, it's a whole long process, much more difficult, a couple of $100,000.
Nothing's really changed from fundraising. All we've done is introduce new legislation to try and cut the pie in different ways.
Simplify.
Yeah. So startup stage, you're still looking for seed capital, friends and family, small bites of the apple, right? So you're not going to get help from broker-dealers for a small raise. If you're looking for $100,000, $200,000, you're not going to get it there. If you're going to then, so you then step up and say, okay, I need $5 million, I need $10 million, I need $50 million. At that point, brokers are going to want to say, okay, great, you have a growth business. We can actually do something with you. It doesn't matter if you're doing it via crowdfunding, via Reg A, which is not crowdfunding. That's traditional investment. It's just a part of it is now we can actually talk and get regular people off the street to invest in it. So it's really, you have to decide for yourself, and if you need to have an attorney or someone like that who can advise you and say, these are the considerations that would be important for a faculty, if faculty are the people that are going to be giving you money, that they are going to be considering. And then with those requirements in place, then you can come out and say, okay, great, yes, we can do Title III. Yes, Reg A is going to be advantageous to us down the line. But it's hard for us up here on the stage and tell you what you should structure yourself as without actually taking the time to understand what's going on a little bit better.
Joel has a question there. Joel? Get the mic.
One of the things that we're struggling with is if somebody raises $5 million or $10 million or $50 million, or maybe the worst would be $1 million or below, they raise the money, and it sounds like a lot of these people might be beginners in business. They don't have financial training. They don't know how to organize things. You just going to cut them a check and say, best of luck, don't screw it up? Or you have any plan for oversight, or leak the money out in tranches, or any thought about that?
I'd like to talk on that very briefly. If you go to Kickstarter, my biggest criticism of what is otherwise a phenomenal platform is that there is absolutely no help and guidance there. It's like, here's your money, bye, good luck with that. What we do within Manhattan Street Capital is we're building a community, which is what I want to touch on before we wrap. Anyone who's a service provider, please sign up and set up a profile on Manhattan Street Capital if you are in the Reg A plus space or serve companies that are in that space. Because we are building a community with mentors, with resources, and we believe in and will get the companies to engage with the community both before and after offerings so that they can do a better job. They can excel, they can find advisors, they can ask difficult questions of experienced mentors that have been down that road before. The former COO of Flextronics, Bob Dykes, is one of our mentors. We will grow the crew, it's about 6 right now, we'll grow to have a very big seasoned panel of mentors. It's a small panel today. You need to have that so that you can increase the likelihood of success of all the companies that are associated with any particular method.
I also think that, yes, you might be dealing with people that are novices in business, but you know what? If it's a good idea and it's a good business, why wouldn't you want to invest in it? I think that's what VC companies or angels, they do it all the time. Let me just tell you, the thing I like about this is that for like a guy like me who, I'm like a lot of you guys, I'm unaccredited. My financial advisor comes to me and says, let's bang out 7% every year. Because I don't have the ability to invest in Uber if they went this route or Facebook. That's what I really like is that, yeah, I might be dealing with people that are novices, but you know what? At least I can take a shot. I can take a shot like any other rich guy around the country. And maybe they'll blow out their money, and 9 out of 10 times those businesses are going to fail. But at least I got the shot.
Well, one thing is under Title III, the portals have somewhat of a responsibility not to just take anybody, and they did not exempt the portals from liability. So a portal is responsible in some manner for the offerings that appear on the portal under Title III. Now, I personally don't think Title III is going to work, but that's just my opinion. I think Title IV is the best thing that's ever happened in the securities industry. It's going to really open up a lot of capital. Would anybody like to address that about Title IV, the up to $50 million from non-accredited investors? Would anybody like to talk about that? Nigel, any comments from you?
No, I'm not in a position to talk about crowdfunding or funding or any of the legislation at all. All we do is move money, and we can help you move money. That's all we can do.
So tell us again, Nigel, what do you do?
Yeah, we move money around. We move $20 billion a year around the world, and that's been built up historically by servicing up to 25,000 corporate entities with paying and receiving funds by selling goods and receiving goods. And we've built up an infrastructure and a network, a banking network that allows us to deliver far more than any bank can to more countries than any bank can at pricing that better than any bank can.
Okay.
And that's how we compete.
That brings up a huge question.
Yeah.
Huge question. Because of the AML, the anti-money laundering rules, I'm right now got an offer from Dubai for an investment. I don't know these guys.
Yeah.
So what do I do? Tell me what should I do in a case like that? And you may encounter a foreign investor, Chinese, EB5 money or whatever. What do we do in cases like that?
Yeah.
To determine, and by the way, is it life in prison for money laundering?
You know what it is? It's nearly.
It's a serious issue.
The industry that I work in, 10 years ago, we had zero regulation. We weren't responsible to anybody, and we didn't report to anybody, and we could just make money from people. Over the last 10 years, and primarily since 9/11, the world changed and legislation changed, and moving money around the world, we're in the highest risk money remittance business because we're the ones that can be used to fund terrorism and launder money. So as a non-bank provider, of that sort of service, we've become extremely regulated and licensed. We're licensed in every state. We're at a level where we can sell options to any level because we've had to be able to survive. Many within our industry have disappeared. The banks have pulled the plugs on their facilities because of the risk in having a third-party company move money on behalf of another person to somewhere else. So we deal with, from the bank's perspective, third-party payments. So the guy in Dubai, we can move that guy's money to you, and it goes through the bank, but the bank has no relationship with either of you. So it's extremely high risk. So one of the things that we've had to do over the last 10 years is invest significantly in that sort of space so that we know how to deal with that sort of thing. We work in all geographies, and like I said, we can deliver to over 200
So do you do
countries.
AML on the people?
Do we do? Absolutely. Absolutely.
So
Yeah.
so I could send a guy to you and say, after you clear him, I could take his money, right?
We can send that money to you, yes, absolutely.
Okay, and the FBI wouldn't get nervous if all of a sudden
Correct.
I've got 10,000 in my bank and the next day I've got 8 million?
Correct. Yeah, correct. We report
Okay.
any transactions just like any bank
Okay.
does. Yeah.
Okay,
I'd
Rod?
like to volunteer something. This may be obvious, but perhaps not. The bad news for you guys is that this is an early development stage industry, so it's hard to get precise answers to some questions. Things that will be obvious later, the ambient knowledge will have grown. Today they aren't obvious. The good news, though, the corollary of that, is that the platforms are new too, in the main. And so you can get hold of human beings much more easily than you will when they're big, successful companies, when you'll be dealing with somebody in customer service who doesn't know what they're doing. Today, you can get through to people, right? So it's if you don't find it easy, go to a different platform and try there. I'm dealing with companies on a frequent basis where I'm explaining what Reg A Plus is, explaining the process, trying to simplify it down to the core remaining 3 key issues that they need to evaluate, rather than having 20 variables floating about, which makes it impossible. And I think that's the good news here, is you can get through to people easily, do so, get their advice, ask your questions. If you can't do it here, do it there, because that's a great thing about where we're at, that people are available.
That's because the company is one guy. Sometimes.
I think we're even doing a disservice by sitting here and saying Title III, Title IV, Reg A. We're throwing a whole lot of nomenclature when at the end of the day, people care about raising money. And so if you ask the questions, is how much money are you raising? What are you raising it for? When are you going to deploy it? What type of investor are you trying to work with? Then it becomes a lot easier because we can just understand the regulations and say, okay, great, you should go this way. And these are the things, and it's going to cost you this much money up front, and you're going to have to pay brokers on the back end if you're doing it that way, or if you're going the VC route, you're going to do it this way, and this is what it's going to be. And so you're very lucky at this early stage because there's lots of us on this stage right now and at this conference that know this stuff and just talk to us and tell us what you want, and we can help. That's really the easiest.
One point of addition is that if you are wanting to have a local impact and sort of get use of public land or something like that for the community good, it may help to be able to bring in non-accredited investors to help sway that vote.
I'd like to add an observation because I know very little about crowdfunding, as I said, and I'm not from that industry. But the cycle that we've gone through in our industry as a payment provider, a remittance company, from zero regulation to how tightly we're regulated now, more tightly than the banks, in actual fact, I would suggest that that's going to come your way at some point. And the catalyst for that is likely to be when something goes wrong. So it was talked about on the last panel that, what's going to happen, and there's going to be reactions if there's fraud and the like. It won't shut it down. They won't reverse legislation. They'll then just take it to the next level. I would suggest that's the way it will go, and you will move into a more and more regulated environment, and that's going to happen to you. Be ready for it and be ahead of the game. Do what the gentleman here was saying about ask all the right questions, understand your customers, your KYC, because that's the foundation of it all. And as long as you do that properly, you'll be ahead of the game, because it'll be like the tide going out on you, and it will leave some people, to quote Warren Buffett, with the trousers down. It's going to be very important for you over the next 5 years, I would suggest.
You got any ideas for getting money out of India?
Yeah, we can do that for you.
Because I've had trouble, people in India that want to send money and they can't.
Yeah, and it's hard to send money into India as well. Yeah.
Oh, it's easy.
Yeah.
They love it. I can send it that way, no problem.
It takes a long time. It takes a long time to build up the networks that you need to be able to deliver to these sort of organizations.
Different countries have different rules, right?
Different rules, different banking systems, different regimes, different just numbering systems, and to connect them all together and make it work efficiently and to comply with everything is very complex. That's why there's only a very limited number of companies that do what we do, because it's taken a long time. We've been around since 1979 and have kind of built this knowledge up over a long time. And that's where we can kind of help you guys.
Okay. I'd like to change the subject a little bit, because I'd like to go back to this situation of a real startup. For example, I'm dealing with a situation right now where the company is profitable. They're a chain of retail stores. They want to raise several $1 million to grow and acquire some other stores, and they're concerned about their valuation. They're also adding a clothing line on the internet and their own design, and they're going to market some clothing of their own design, and they feel that changes their valuation. So if we could get, and most startups, their valuation is based on what, a discounted cash flow, and they have on their projections. So you want to talk about valuation based on nothing. How do I value a startup?
So if they have traction of any sort, that's what you start using as metrics. And you look at the cost of acquisition of a customer and the long-term value, and you can back into an equation or a value for that individual. And if they have traction, they get 5 of them a month, 10 of them a month, and then you extrapolate.
So I want to add to this, because I have a lot of experience in this space of valuing startup companies, valuing companies that are small and mid-sized. In the startup case, when it comes down to, we don't need to complicate it with the discounted cash flow and net present value of the business, because frankly, there are too many assumptions in there, and you end up getting lost in the numbers too easily and losing sight of the main issues. Is it a big market? How big is the market? Is it a giant big market? And how much market share might you reasonably attain with this offering that you're planning to build? And how defensible is it? Is it truly defensible, or is it too easy to be knocked off? Is it dependent only on a land rush program where you own it suddenly magically and now you can defend it because you're big? Or do you have real barriers to entry? If you pass those 3 tests, now I'm interested. That's the first thing. Now I'm paying attention. Now I'm thinking, how much money do you need? Is it engaging for me? Is there an upside in this? And of course, you are looking at the future valuation potential for this company and the future liquidity potential for it. But it's not just numbers. It's more about the quality of the team and the market and the other things that I just listed, right? And from that, you end up with this particular very simple rule of thumb. If you can engage enough interest to raise enough money to do a 1.5 years or so of business in your startup company, then you're going to end up, you should expect to get 1/4 to 1/3 dilution in that process. If you get away with less than that, more power to you. That's the rule of thumb that I use, and it works pretty well. Because if, let's say you need $4 million to do your business, to build the business, then if you can engage enough interest from real people that have collectively the $4 million, then that means you've already established the worth of this opportunity, and of course the valuation goes with it, right? That's the bottom line. You aren't really going to get a $200 million valuation for a $4 million raise, are you? But equally, you're not going to value the company at $2 million pre-money for a $4 million raise. People understand. If you're dealing with consumer investors like we are in Reg A+, it's possible to overvalue businesses, which we have to be very careful to prevent, because in the aftermarket, of course, that'll end up being corrected, and that would be a very unfortunate outcome for the investors and the offering companies and platforms. But I hope that was useful on the startup valuation.
You know, working a lot in the Los Angeles area, most of the startups that come up get their legal services basically deferred, right? So they get about $10,000. They get their legal services deferred, the cost. They get about $10,000 from some big firm, and what they get is basically a offering that basically values the company at $2.5 million day one, and it's absolutely kind of ridiculous. And I think that we relate this to the accounting world, and the fact that the fair value of a company is really what a willing buyer and a willing seller can transact at. And so often that we see companies where they're issuing shares, and those shares, to the person that's getting them, they think, oh my gosh, this is a $2.5 million company and I'm getting $30,000 worth of shares. How great is that? And then we as accountants look at it and, well, you know what, you're actually, your last sale of stock was for a penny. So that's really what the shares are valued at, and that you really gave that person about $30 of stock.
You got $300 worth of stock,
yeah.
Right?
And on the flip side, there's times where you sell shares, over that valuation, and you can cause people some tax problems too by issuing them shares that are worth a heck of a lot more than you thought they were, especially if you're doing like an M&A deal and you issue them a lot of shares, and that's a taxable event.
Why are the convertible notes in such favor? Is it because you can do a note without really having a valuation?
It's just deferring it until an actual round. You're getting money up front, and you're saying, well, we'll deal about the valuation later.
Are most of the ones you see, are they no interest notes with capped notes, or what are they?
Right now, the SAFE is the model of choice for the startups.
The
so
what?
500 Startups has created a model that it's basically a warrant. It's not even a convertible note anymore. We're saying, here, you give us this money, and then we'll talk about it in 6 months.
And we're going to give you some shares, not even the number of shares?
No, you're essentially saying, I'm going to get something in the next round when we actually do the valuation, and we're going to do the heavy lifting. But right now, you're a napkin idea at a discount. Yeah.
So, in my view, convertible notes where the valuation will be determined by some future institutional event that may or may not occur, I don't do those deals because it's too uncertain. I'm getting into the company now at high risk. 2 years from now, it may be a drastically higher value business then. It might be worth 4 or 10 times what it's worth today.
So what do you do?
I don't want a 20% discount from an institute.
So what do you prefer?
You can set the terms. That's what I've done with my round for Manhattan Street Capital.
Well, I mean, so you do equity.
Yeah, you can sell equity, or you can do notes that are convertible into equity at predetermined terms.
Right.
And you can protect them against dilution anyway. But the point is that a lot more investors are prepared to take a risk if they know what they're paying for a share, what's the valuation of the company. The company which is now Pandora was Savage Beast. I wanted so much to invest. They, in 2001...
Is that the mining company in Avatar, Pandora?
Yeah, no. No. It's the same name, unfortunately, for them. Anyway, it was called Savage Beast, wonderful startup company, indeterminate deal. If and ever we do an institutional round sometime, you'll get a nominal discount from that round. If you're lucky, blah, 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 bullshit. There's no way I would do that deal. I haven't gone back to calculate if I lost, how much I lost from that. But the point is the same, is, if you're taking that much risk, you need to at least lock in the terms that protect your investment, because you don't want it geared up to a future round. It's too uncertain.
Now,
Reg A is for bigger growth companies or companies that have been around for a while. They might not be revenue, but there's significant milestones. They've done 3 rounds of Ds. They've done everything else. So there's history. Whereas Title III in the crowdfunding space, there's probably not. So that's where you're thinking more of startup. Think of what we're doing here in Silicon Valley, early stage.
That's what I'm talking about. I'm talking to that. I've done both, right? I haven't actually done a Reg A transaction yet, but I've done loads of investing in seed stage companies and other angel investing. That's my personal preference I'm expressing.
Okay, yeah. I'm just trying to clarify for the audience and saying that if you are Reg A, you're not startup. So don't think that you're going to come straight out the door and do a Reg A if you're a startup, because you're not going to get much success.
You have to be one of those 4-year overnight successes to be a startup in Reg
And very few startups, you know, have a couple of $100,000. They're looking for a couple of $100,000 usually. Now, we should probably have some more questions from the audience.
Isn't Title III basically the same as angel investing done on the internet? I mean, you can offer essentially the same kind of terms as private angel investing.
But it's seed investing for all investors, not only accredited
It's only $1
investors.
million, so that it would be considered a seed round.
I'd like to say one thing about Title III for those of you that are interested in using it. In my view, currently the marketing is rather restricted because you're only allowed to market your offering within the portal that you are making the offering on. So until there's a giant portal, then you're talking to a limited audience, and I think that's going to slow down the acceptance of Title III and make it more risky in the early days. And I'm hoping that the SEC will take the shackles off for marketing when they see that the level of fraud is not as bad as has been feared.
I think the real difference, the way I see it, is if you do angel investing, you might get, let's call it $100,000 from 5 different people and for a total of $500,000, but you have 5 people. The real power of Title III comes if you can get investments from 5,000 people who become 5,000 advocates, as someone was saying earlier, who can send out 5,000 tweets, who become 5,000 customers. Because most businesses don't fail because they have necessarily bad ideas. Most businesses fail because they can't get any market traction. So the way I see it, if you're a smart person, you can bypass all the convertible debt that comes with all these contingencies. You can do a Title III. You can raise enough money. And if you get enough market traction and have a good business idea, you can parlay some of that cash into a Reg A plus deal. And then you can get even more money. And guess what? You already have a base of investors, and you have a base of customers, and you have a base of stakeholders. And if you're smart, I think that's what you do.
Is that contingent upon such a portal, a giant portal, existing in order to attract those investors?
I think that's the one thing about Title III is that, yes, the issuer, U.S. companies are going to have some restrictions on advertising, but the giant portal doesn't need to exist in order for it to work. Make no mistake, Title III is going to be by far one of the most game-changing elements in the United States. It's the most talked about exemption all around the world. And there's been so many countries already who have been adopting new regulation just to make sure that they weren't falling behind U.S. So I realize it's not the perfect exemption, $1 million, but you've got to walk before you can get it all. So I firmly believe that there are going to be companies that are really going to take advantage of Title III and do extremely well. To what David was saying, I'm going to see a lot of companies that are going to use it as a stepping stone to Title IV. We're going to see some of them playing with Title II and Title III raises simultaneously. Something we're also going to see is portals that are operating under Title II and Title IV, introducing Title III as well. So that just goes to show you is that we want to give you the choices. What do you want? As David asked earlier, how much money are you looking for? Who's your target audience? What kind of investors would you like to have? I'm a big advocate of the more investors you have, the more growth you will have. I truly believe that. I think one of the biggest mistakes all companies make is that you want one investor. Well, one investor is not going to get you a whole bunch of customers. 5,000 shareholders, ambassadors are going to get you so much more. And it's not just the likes, it's not just the retweeting, but these are people that are going to be so proud of being part of your company that they're going to actually be your best salespeople, and it's going to cost you nothing, absolutely nothing. So it's an exciting time. We're only 2 months away. So the real key for you now is just getting prepared. And there's a lot of experts here today. Lawyers should be the first ones you be talking to, and then afterwards you talk to us, the service providers.
And on that note, Sydney has signaled us that we're closing up, and there's cocktails waiting out there. Ladies and gentlemen, we thank you very much.
Thank you.